Welcome to our price action course session where we dive deep into the world of channels and provide you with 23 valuable tips and 3 powerful trading strategies. In this video, we will guide you through the ins and outs of effectively using channels in your trading. Channels are a vital tool for identifying trends, support, and resistance levels, and can greatly enhance your trading decisions. Throughout the session, we will share 23 expert tips on how to effectively analyze and interpret channels. These tips will help you gain a comprehensive understanding of channel patterns, breakouts, and reversals, enabling you to make more informed trading decisions. But that's not all. We will also reveal 3 powerful trading strategies specifically designed for channels. These strategies have been carefully crafted by industry experts and have proven to be highly effective in capturing profitable trades within channel formations. As you continue watching until the end, you will gain valuable insights that will empower you to harness the full potential of channels in your trading. Our aim is to equip you with the knowledge and skills necessary to navigate the markets with confidence. We greatly appreciate your support and encourage you to leave any questions or comments below. Our team is dedicated to addressing any queries you may have, ensuring that you have a thorough understanding of the content covered. Once again, we extend our gratitude for your support and hope that the information presented in this video will prove invaluable in your trading journey. So sit back, relax, and let's dive into the world of channels and trading strategies. See you after intro. Hey there, Smart Money Atlas is in the house. Welcome back to our course in price action, where we dive deep into the exciting world of trading. Today, we have an incredibly informative video lined up for you, all about channels in trading. Whether you're a seasoned trader looking to brush up on your skills or a beginner eager to learn more, you've come to the right place. Channels are an essential concept in technical analysis, and understanding how they work can greatly enhance your ability to predict market trends and make informed trading decisions. In this video, we'll be taking you on a journey through the world of channels, exploring what they are, how they form, and most importantly, how to effectively use them to your advantage. Get ready to expand your knowledge, refine your skills, and take your trading prowess to new heights. 1. For channel drawings, having only 2 points is enough. In bullish trends, 2 lower highs, and in bearish trends, only 2 higher lows are enough. Once you have identified these 2 points, you can draw a straight line connecting them. This line represents the support or resistance level of the channel. From here, you can draw a parallel line on the opposite side of the price action, which represents the opposite support or resistance level. 2. Price is not obligated to react to drawn trend lines. In price action concept, probability is the ruling sovereign. This means in markets realm certainty does not have a place. A trader can only predict the future behavior of any market by assessing its previous history and price context. This is also true for human nature, and market is a function of humanity. Therefore, it is important for traders to understand that while trend lines can be helpful in identifying potential support and resistance levels, they should not rely solely on them to make trading decisions. Instead, they should focus on assessing the probability of the market's future behavior based on its past history and current price context. This understanding reflects the fact that markets are inherently uncertain and subject to human nature, which can be unpredictable at times. In previous sessions of our course, we talked about 40 to 60 rule in the market and discussed that if a trader could only predict 60% of the market, success will follow. 3. Channels happen within channels. By recognizing a channel, also other channels and patterns can be found within. Meaning by changing time frame in charts or data range, it is possible to look for other patterns and channels inside the bigger channels to open trading positions. It is also common to see channels within channels in opposite direction. This can be seen as a form of nested channels or fractal patterns within the larger channel. Traders may use this information to identify potential trading opportunities and make more informed decisions. By analyzing the smaller channels within the larger channel, traders can look for potential entry and exit points, as well as determine the overall trend and direction of the market. 4. A failed breakout is a lost cause. After each failed breakout's price returns to its origin channel. If a breakout occurred and the momentum of price movement could not continue, then a retreat is on the way and price will go back to where it started. But remember, price now has a new extreme and late channel should be revised, a new channel must be drawn. This means that when a breakout fails, the price of an asset will typically retreat back to the original channel it was in before the breakout attempt. However, it is important to note that the failed breakout creates a new extreme point, so the previous channel needs to be adjusted or a new channel needs to be drawn to reflect this new price movement. This allows traders to analyze the failed breakout and identify potential trading opportunities within the new channel. 5. Every time a channel is updated, it becomes milder and turns to a trading range. By revising old channels, a new trend line is drawn each time. It is obvious that channel will become milder and will lose its sharpness. This means that the price movements within the channel become less extreme and more contained. After a while, a trading range will appear in chart and the channel will vanish. As this process continues over time, the channel eventually transforms into a trading range. A trading range is a period when the price fluctuates within a relatively narrow range without showing a clear trend in either direction. As we talked before, the best setup for trading ranges is BLSH, which means traders should buy at lower price levels within the range and sell at higher price levels. Therefore, remember, the new trend line is our new decision-making criteria. Traders should consider this trend line when making decisions about buying or selling within the trading range. 6. Channel is a phase between spike and trading range. Any sharp price movement is called spike, as shown in diagram. A spike refers to a sharp and sudden price movement in a particular direction. This can be seen as a significant increase or decrease in price within a short period of time. Spikes can occur due to various factors such as news events, market sentiment, or significant buying or selling pressure. Once a spike occurs, it is common for a channel to form. A channel represents a phase where the price fluctuates within a defined range without showing a clear trend. This range is typically characterized by parallel lines drawn along the highs and lows of the price movement. Channels can be either ascending, upward sloping, descending, downward sloping, or horizontal, sideways. However, it is important to note that drawing channel lines from the start point of spikes is not always recommended, especially if the spikes are steep or extreme. Steep spikes can often be misleading and may not accurately represent the future price movement. Therefore, it is advised to wait for a pullback, which refers to a temporary reversal in the price after a spike, before drawing channel lines. Steep spikes are known to be deceiving and, in these conditions, it is advised to wait before plotting a channel. Nevertheless, try to catch spikes. Waiting for a pullback allows traders to assess the stability and sustainability of the price movement before plotting a channel. By doing so, they can avoid potential false signals or misinterpretations caused by steep spikes. Despite the cautionary approach towards drawing channel lines, traders can still attempt to catch spikes. Spike trading is considered one of the best strategies available in technical analysis. 7. Channels are a flag pattern in higher time frames. In technical analysis, channels are often seen as flag patterns in higher time frames. A flag pattern is a continuation pattern that occurs after a strong price move and represents a temporary pause or consolidation before the price continues in the same direction. When a channel is identified in lower time frames, it suggests that a flag pattern is forming in higher time frames. This means that the price is likely to continue its previous trend once the consolidation phase is over. If you are unsure about how to interpret and trade flag patterns or any other classical patterns, watch our session about classical patterns. Understanding classical patterns and how they relate to channels can enhance your technical analysis skills and improve your ability to identify potential trading opportunities. 8. Know when to scalp. In scalping, traders take advantage of short-term price movements within a trading range. When a channel starts to have deep pullbacks, it indicates a loss of momentum in the previous trend. Look at this example. As a bullish channel loses momentum, buyers get more unconfident of trend. This uncertainty causes buyers to become less confident and they start to compromise their profit margins. On the other hand, sellers enter the market with more confidence and begin to take small profits from the market. As both sides start to gain small profits, a balance is established between buyers and sellers, resulting in a trading range. This trading range continues until one side gains momentum and takes control of the trend, either continuing it or causing a reversal. Scalpers capitalize on these short-term price fluctuations within the trading range by entering and exiting trades quickly to capture small profits. It is important for scalpers to closely monitor the market and be able to identify when a trading range is forming, as well as when one side gains momentum to potentially take advantage of the next trend. This requires a thorough understanding of technical analysis and the ability to interpret price action patterns. 9. Always keep an eye for shadows. Traders should always be vigilant and pay attention to the presence of shadows in candlestick bars. These shadows, specifically long tails at the end of channels, serve as a warning sign of a decrease in the momentum of the current trend. To determine if the momentum is still running, scalpers should observe if the close of a candlestick bar is near its high point and if the bar is converging with the trend. This indicates that the trend is still strong. However, if there are long shadows in candlestick bars, especially in the opposite direction of the trend, it suggests a change in trend behavior and a possible retracement or pullback. During a session on candlestick patterns, this topic was thoroughly discussed. If you missed this session, it is highly recommended to watch it attentively to gain a better understanding. When a retracement is occurring in the market, big shadows will form in the chart's candlestick bars. These shadows can also indicate a failed breakout in lower time frames, meaning that price attempted to break a price action zone but failed and consolidated there instead. In conclusion, an increase in the number of candlesticks with long tails at the end of channels serves as a warning of a potential reversal or retracement of the trend. It is advisable for traders to wait for the market to move out of this state of confusion before making any trading decisions. 10. Channels tend to gain momentum in their direction. In a mild channel, the trend's momentum gradually intensifies and becomes more prominent in the direction of the channel. This implies that as the price consistently moves within the channel, its momentum increases, leading to a steeper angle of the channel. Consequently, this steeper angle signifies a robust and enduring trend in the market. The continuous strengthening of the trend's momentum within the channel suggests that market participants are increasingly confident in the prevailing direction, leading to a sustained and potentially profitable market movement. Traders may interpret this as an opportunity to capitalize on the strong trend by strategically entering positions aligned with the channel's direction. Thank you for watching until this point of the video. We appreciate your support and encourage you to continue watching until the end. By doing so, you will gain a complete understanding of these trading strategies and how they can be applied in the market. Additionally, if you have any questions or comments, feel free to leave them below, and we will be happy to address them. Thank you again for your support, and we hope you find this video valuable. Let's continue our journey with number 11. Available trendlines in chart come in handy and predict future market behavior. Look at this example. Here, 3 trendlines are drawn. There are trend reversal signals happening in the market. If you can't recognize them, we suggest watch our session about major trend reversals. Once a trade position is opened, the initial take-profit point is set at the level where it touches trendline number 3. This means that if the price reaches this level and the trade is profitable, the trader can close the position and take their profits. If the price continues to move in the desired direction beyond the initial take-profit point, the trader can set a secondary take-profit point at trendline number 2. This allows them to potentially capture additional profits if the trend continues. Finally, if the trend's momentum is particularly strong and the price keeps moving in the desired direction, the trader can set a maximum take-profit point at trendline number 1. This represents the highest potential profit target based on the strength of the trend. By using these trendlines as reference points for setting take-profit levels, traders can strategically manage their trades and potentially maximize their profits based on the observed market behavior. 12. What goes around comes around. When there is a breakout in the same direction as a channel, there is often a tendency for the price to eventually reverse back into the channel. In other words, if there is a bullish breakout in a bullish channel, there is a high probability that the price will eventually move back into the channel in the next 5 candles. However, it is important to note that this is not a certainty and there is no guarantee that the market will always behave in this manner. The time frame for the price to come back into the channel may vary and could be a few candles more or less than 5. Additionally, market reactions are not always predictable and can be influenced by various factors. Therefore, while this pattern may occur frequently, it is not a foolproof strategy and should be used in conjunction with other analysis tools and risk management techniques. 13. Each trend consists of 2 phases. Spike and channel. In the spike phase, the price experiences a strong movement in one direction without significant pullbacks. This often occurs after a breakout, where the price breaks through a key level of support or resistance. During this phase, traders typically enter trades in the direction of the spike, as it indicates a strong momentum in that direction. The expectation is that the price will continue to move in the same direction and potentially generate profits for the trader. However, in the channel phase, the price tends to move within a range or channel, oscillating between support and resistance levels. Depending on the type of channel, there may be opportunities to catch pullbacks and enter trades in the opposite direction of the spike. For example, in an ascending channel, where the price is making higher highs and higher lows, traders may look for opportunities to enter trades during pullbacks or reversals towards the lower boundary of the channel. This is based on the assumption that the price will eventually reverse and continue its upward movement within the channel. It's important to note that trading reversals within a channel can be riskier compared to trading in the direction of the spike. The price may continue to move within the channel or even break out of it, resulting in potential losses for traders who entered trades against the prevailing trend. Therefore, traders should consider other indicators and tools, such as support and resistance levels, trend lines, and moving averages, to confirm the likelihood of a price reversal back into the channel. They should also implement proper risk management strategies, such as setting stop-loss orders, to limit potential losses if the price does not behave as expected. Overall, while it is possible to catch pullbacks and reversals within a channel, traders should exercise caution and conduct thorough analysis to increase their chances of success. 14. Deep pullbacks happen when previous extremes fail. Deep pullbacks occur when previous extremes fail, meaning that in a bullish trend, a lower low forms, and in a bearish trend, a higher high forms. This indicates a potential shift in momentum and a possible reversal in the trend. In a bullish trend, for example, if the price has been making higher highs and higher lows but then forms a lower low, it suggests that the buyers are losing control and the bears may be gaining strength. This can be seen as a deep pullback and may signal a potential trend reversal. Similarly, in a bearish trend, if the price has been making lower lows and lower highs but then forms a higher high, it indicates that the sellers are losing control and the bulls may be gaining strength. This can also be seen as a deep pullback and may suggest a potential trend reversal. It's worth noting that pullbacks can also occur after a breakout of a price action zone. For example, if the price breaks through a key level of support or resistance, it may retrace back to that level before continuing its trend in the breakout direction. This retracement can also be considered a pullback. Pullbacks can take different forms, including single candle bars or complete movement legs. There is no strict requirement for the length or duration of a pullback. The momentum of pullbacks can serve as a clear phase-changing signal in trends. It indicates a potential shift in market sentiment and can be an opportunity for traders to enter trades in the opposite direction of the previous trend. Deep pullbacks occur in bullish trends when a lower low forms, and inverse is true in bearish trends, which happen when a higher high forms. As discussed in previous session, one of the most important pullbacks is after break of a price action zone and price coming back to these zones to start a trend. 15. Each strong spike could be clear signal for start of trend. In candlestick charting, a spike is identified when the main body of the candlestick bar is large. The main body represents the difference between the opening and closing prices of a trading period. So, a large main body indicates a significant price movement during that period. Effective spikes are typically characterized by not having big shadows following them. Shadows, also known as wicks or tails, represent the price range between the high or low of the trading period and the opening or closing price. A spike without big shadows suggests that the price quickly moved in one direction without significant retracements or reversals. Spikes are efficient as long as market doesn't have pullbacks in it. This means close of every spike can be a potentially good entry point depending on trade strategies. 16. In channels, it is possible to trade in both directions. After the spike phase of the market ends and transitions into a channel phase, it is possible to enter trades in both directions within the channel. This means that traders can take both long, buy, and short, sell positions depending on the price movement within the channel. However, entering trades in the opposite direction within the channel should only be done by professional traders. This is because trading against the overall trend can be riskier and requires a deeper understanding of market dynamics and potential reversals. In summary, during a channel phase of the market, traders can potentially profit by entering trades in both directions, but it is important to exercise caution and consider the overall trend before taking positions against it. 17. Occasionally, market after a spike shifts to trading range. This means that instead of experiencing significant upward or downward movements for spikes, the price remains relatively stable and moves between two parallel lines. This phenomenon is commonly observed in currency markets because they are influenced by various factors such as economic indicators, geopolitical events, and central bank policies. After a spike in price caused by a sudden event or news release, the market may enter a phase of consolidation where traders reassess their positions and wait for further developments. 18. Avoid trading when everybody sleeps. It is not advisable to trade during periods when the majority of market participants are inactive or asleep. This is because trading activity and liquidity tend to be lower during these times, which can lead to wider spreads and potentially less favorable trading conditions. Many financial markets operate 24 hours a day, allowing traders to participate in trading activities at any time. This means that there are opportunities to trade even outside of regular market hours. However, it is important to have a schedule and to be disciplined as a trader. Traders should establish a routine and stick to it, rather than trying to trade at all hours of the day and night. This helps maintain consistency in trading decisions and allows for proper rest and work-life balance. Traders should know to stop trading when major market makers and professionals do. This is because these participants often have significant influence on market movements and can create volatility or sharp price movements when they enter or exit positions. By avoiding trading during these times, traders can reduce their exposure to potentially unpredictable market conditions. This indicates the importance of considering market activity, liquidity, personal schedule, and the behavior of major market participants when deciding when to trade. It encourages traders to be disciplined and strategic in their approach to maximize their chances of success. We will talk about this matter in separate session of our free price action course. Stay tuned to be the first to watch it. 19. For recognizing a channel, always check for minimum requirements. There are certain minimum requirements that need to be met. In a bearish channel, one should look for a pattern of lower lows, meaning that each subsequent low point in the price chart is lower than the previous one. Conversely, in a bullish channel, one should look for a pattern of higher highs, where each subsequent high point in the price chart is higher than the previous one. By checking for these minimum requirements, traders can confirm the existence of a channel and its direction. This information can be useful for making trading decisions, such as identifying potential entry and exit points or setting profit targets. 20. Narrow channels are spikes in higher time frame. When market is confusing and it is hard to recognize a pattern, try to alter the time frame. When the market is confusing and it is difficult to recognize a pattern in a narrow channel, traders can alter the time frame they are analyzing. By converting the time frame to a higher one, they may be able to identify a spike or a clearer pattern. Likewise, in narrow channels, by converting time frame to higher one, a spike can be found. The idea is that by zooming out and looking at a larger time frame, traders may be able to see a more significant move or trend that is not as apparent on smaller time frames. This can help provide clarity and potentially identify opportunities for trading. However, it is crucial to exercise patience and refrain from hastily opening a trade position. Instead, maintaining a calm and composed mindset is essential. By doing so, traders can better navigate the market and seize the window of opportunity that it presents. Remember, the market is dynamic and ever-changing. It is only a matter of time before it reveals a favorable moment for trading. We appreciate your support and would like to encourage you to continue watching until the end. By doing so, you will gain valuable insights into the remaining tips and strategies related to channels. If you have been enjoying the video thus far, we kindly ask for your continued support. Watching until the end will ensure that you receive a comprehensive understanding of how channels can be effectively used in trading. We understand that you may have questions or comments regarding the content we have covered so far. Please feel free to leave them below, and we will be more than happy to address them. Once again, we would like to express our gratitude for your support, and we hope that you find the information presented in this video valuable. 21. Do not swim against the current. Channels with strong momentum have minor pullbacks, and like narrow channels, it is best to trade in trend direction. This means that the price may temporarily move against the trend before continuing in the same direction. Traders who are looking to take advantage of these channels should aim to trade in the direction of the trend. When trading in channels with strong momentum, it is important to pay attention to the strength of the candlestick bars. Strong candlestick bars indicate a high level of buying or selling pressure and suggest that the momentum is likely to continue. In these cases, reversal traders and scalpers may set their profit points at a minimum, as they expect the price to continue moving in their favor without significant pullbacks. 22. Weak channels are very similar to trading ranges. In weak channels, the price tends to fluctuate within a relatively narrow range, similar to trading ranges. This means that traders can take advantage of the price movements by buying at the lower end of the channel and selling at the higher end. By buying low and selling high, traders can potentially profit from the price movements within the weak channel. However, it's important to note that trading in weak channels can be risky as the price may break out of the channel and establish a new trend. Therefore, it's crucial to set stop-loss orders and manage risk effectively. 23. Weak channels check with 5 characteristics. 1. Candlestick bars overlap with each other and the market is confused. In weak channels, the price action tends to be choppy, with candlestick bars frequently overlapping and lacking a clear direction. This indicates that market participants are unsure about the next move and are indecisive. 2. Trend frequently changes direction. Unlike strong channels where the trend is well defined and continues in one direction, weak channels experience frequent changes in trend direction. This can be seen through the formation of higher highs and lower lows, as the market lacks conviction and struggles to establish a sustained trend. 3. Big shadows appear in highs and lows of channels. Weak channels often exhibit large shadows or wicks in the highs and lows of the price action. These shadows indicate that there is significant price rejection at these levels, suggesting a lack of strong buying or selling pressure. This further confirms the indecisiveness and uncertainty within the channel. 4. Opposite direction candle bars happen in channels. Another characteristic of weak channels is the occurrence of candle bars that move in the opposite direction of the prevailing trend within the channel. These counter-trend moves can be seen as temporary retracements or pullbacks, but they highlight the lack of strength and conviction in the current trend. 5. Major pullbacks and swings appear. Weak channels are often characterized by major pullbacks and swings in price. These pullbacks can be sharp and deep, indicating that there is a lack of sustained buying or selling pressure to drive the price in a particular direction. Traders need to be cautious when trading within weak channels, as these pullbacks can lead to false breakouts or reversals. By considering these 5 characteristics, traders can identify weak channels and make more informed trading decisions. However, it is important to note that these characteristics should be used in conjunction with technical analysis tools and indicators to confirm the presence of a weak channel before executing any trades. We appreciate your support and would like to encourage you to continue watching until the end. By doing so, you will gain valuable insights into the best strategies related to channels. 1. Breakout strategy. This strategy involves trading the breakout of a channel. Traders wait for the price to break out of the upper or lower boundary of the channel, indicating a potential trend reversal or continuation. When the breakout occurs, traders enter a position in the direction of the breakout and set a stop-loss order below the breakout point to manage risk. 2. Mean reversion strategy. This strategy aims to capitalize on the price's tendency to revert back to the mean within a channel. Traders identify overbought conditions near the upper boundary of the channel or oversold conditions near the lower boundary. They enter a position opposite to the current trend, expecting the price to revert back towards the mean. Stop-loss orders are placed outside the channel boundaries to limit potential losses. 3. Range trading strategy. In this strategy, traders take advantage of the price oscillations within a channel by buying near the lower boundary and selling near the upper boundary. They set buy orders near the lower boundary and sell orders near the upper boundary, aiming to profit from the price bouncing back and forth within the channel. Stop-loss orders are placed outside the channel to protect against unexpected price movements. That is it for this session of Price Action course. If you enjoyed, you know what to do.